the president choosing an economist by the name of EJ Antoni. You might recognize the name. He's been on this show many times from the Heritage Foundation. He's also been critical of the Bureau in the past, critical of the data in the past, and now he's floating this idea of suspending the monthly jobs report, at least for the time being. Doug Flynn joins the program, certified financial planner, co-founder at Flynn Zito Capital Management. Couple of things. So, first of all, what do you make of that idea of that we might not get a jobs report every month? I guess the theory that EJ's thrown out there is like, all right, we got to do a better job of collecting the data, so we got to figure it out and we'll only put it out quarterly. Is that a good idea, bad idea, indifferent idea? What do you say?
I don't love quarterly, but what I also don't love is that every number they come out with is allowed 4 revisions. So I think they need to do a better job if they're going to put out a number that we can't allow it to be subject to 4 revisions, which is basically the system that they consider the gold standard, by the way. They keep saying it's the gold standard of data. And I'm like, how many gold standards have 4 revisions that are allowed? I mean, what does a silver and a bronze standard look like if that's the case for a gold standard? I think that that's what they're trying to cut down on, maybe give more accurate data. If monthly's too often, then they need to cut that back. So that's where this comes from. Until they can really get a handle on delivering accurate information, then maybe they could step it back up.
Okay, now who is EJ Antoni? Well, he's a conservative economist. That's what you're going to get from Heritage. He was, like I said, he was on this show a number of times. I'll play a clip that'll set up the conversation we wanted to have anyway about where we are with like the tariffs and the inflation and everything. I would suspect once he gets in there, because this is how it is, he'll probably have to tell Trump, or he'll realize and he probably knows this already, that the data might not be great. We got to figure out a better way to collect it, but there's no reason to believe it's political or it's fixed or rigged. And anyway, we've never seen any evidence of that. But here's how he thinks when it comes to the economy. This is the last time he was on the show. This 100% tariff on semiconductors, can you go into that, the economics of that?
What we're seeing is kind of this carrot and stick approach once again with the president, where, sure, you have obviously the stick is the tariffs, right? But then you have this carrot, which is a combination of things. What we have already seen, and I think what we'll continue to see now because of what this president is doing, is more and more foreign companies producing things here in the United States.
Okay, so that's, he agrees with how the president is approaching things economically. No surprise. That's why he's joining the administration now. It does set us up to talk about what the effect of these tariffs has been. What does the future hold? We got the inflation data out today, and it was, pretty much in line, holding steady on the headline number. I think when you take out the food and energy, it was a little bit above the estimates. But what would you say about, this approach on tariffs and the effect it's having on the prices we pay for stuff?
Well, I think all the talk about how the tariffs are going to cause a big spike in inflation is where they got caught with that not happening. It may be that the inflation rate is a little elevated due to the tariffs.
Right.
But this is all because they put this artificial 2% target as what they've been trying to get to. As we've talked about, the 50-plus year average of inflation, the CPI number, the average over all that, is about 2.9 or 3%. So they could have just as easily come out with a 3% target or a 2.7% target instead of a 2. So, maybe it's a little elevated, but we didn't get that big spike. And I think that's what the market's reacting to, is without the spike, this is sort of a normal, very good overall inflation rate if we could just stay in and around here. And it seems like we've been doing that. So the market's really anticipating that there's almost no reason to keep rates where they are. They're too high. And that expectation for a rate cut next month has really skyrocketed to over 94% right now is what the market's banking on. And those numbers were way low just a week ago. So that's improving for that.
The question on costs, on prices is, to your point, okay, maybe we're paying a little bit more now than we were, and that you can say perhaps is because of the tariffs. Okay, but will we be paying a lot more later? In other words, with that's always been the people who are against the president's policies. That's what they're going to say. What do you say?
Well, I think then we should have seen some of that a lot more start creeping its way in here and there. And I don't, in certain instances. Look, they've done a good job with China. They've delayed that for another 90 days. And if you remember at the high point, we were assessing 145% tariff on them, and they were doing a 125 on us. That's back down to 30 and 10 for another 90 days. Yeah, so if in good faith you're negotiating, I think that's the benefit there. They don't have the European deal, perhaps something like that or closer to it may come, but this is all part of the negotiating. So we're waiting for the big spike, and that's what everyone said. That hasn't happened, and so maybe we pay a little bit more, not all the way down to 2%, but it's not spiking. So here we are looking for that rate cut. I think that's coming.
And if it's coming, the market's anticipating it. Thank you, Doug. Closing bell.